Let's first give a warm welcome to our first guest of the show, Jean Ergas, Senior Economist at Global Capital Group. Dr. Ergas, thank you so much for being with us today.
It's a pleasure.
So we are observing a sort of positive, good conditions stock market in the US right now in this trading session. Is it a small correction from what we've observed in the last few weeks, or do you think the correction that was going on in the American market is actually gonna go on for the next future?
Well, I think it's a complex question, but I look at things in a very short-term way because I'm a Keynesian, and I think in the long run we are no longer there. I think what is actually going on now in the U.S. is that people have woken up that there are problems. These problems are not going to be solved in the short term. Therefore, the key issue is whether these problems are manageable. The response seems to be, yes, we can live with the status quo, which is not perfect. Okay, the question then becomes political. What happens after the midterm elections? So now we refocus away from international very briefly and look at the U.S., which is the key to the highway here. And we think that there's going to continue to be a bit of, let us put it this way, agitated waves here. The sea will not be smooth. We believe that a lot of stocks were overvalued. There's been something of a correction. The wild card is going to be the Fed in December. We believe the Fed will raise, but we believe that ultimately the market will understand that the Fed has not lost its senses, but is trying to quell or quash, let's put it this way, speculative bubbles. So we think they could correct again. We don't expect a crash. I think in terms of a maximum downside, I'd be looking at around 25.50 personally at this point.
Right, and speaking, Dr. Ergas, speaking fixed income today, if we take a look at what the path of the Fed seems to be right now, in terms of the hikes, how positive are you, how confident are you that there's going to be a new hike in December? And speaking about March, do you also think the Fed will raise rates in March? And if that's the case, what is going to happen? Is it going to be too fast in a way, and we're going to observe a sort of shift from a fixed income from equities to fixed income, or not yet?
Okay, that's a very good question. What we're really looking at is what is we term the switch rate. At what point do people get out of stock and into bonds? I think that the switch rate is coming close. This is true. I think the question to really ask is, the Fed raises rates, operates, influences short-term rates. What happens to the Treasury bond? Is it already discounting this? We think to a certain extent that the 10-year bond, which is the barometer, has already built in or is building in a further rate rise. We see more than the switch. What we see is over time, in the short term, less money going into stocks in an average portfolio, and cash and fixed income, once again, becoming a key component of asset allocation permanent, and not simply of where I park cash before I put it in stocks. So here we are looking more at the long-term undertow.
Let's also take a look at Europe once again. We said how the index is closed. Let's also take a look again at the FTSE MIB, and not only also the French stock index closed up 2.31%. A good day also for the DAX, up 1.42%. As you can see, here's the DAX and the level that it closed today, 11,447. Good day also for Spain. A sort of positive picture for the whole of Europe. As we know, the ECB is still behind in the process of tapering, because it's still it's still carrying out its quantitative easing. If we look at inflation, we've seen a positive number today. Inflation actually increasing a little bit more than expected for the entire Eurozone. What's going to happen from an inflation point of view? What's your thought on that?
Okay. Thank you very much. It's an excellent question. I think, one, I believe that if inflation increases, it will be a mild increase. We are not seeing the Weimar Republic and hyperinflation here. We are coming out of a de facto deflationary environment. Two, I believe that the ECB will be cautious in raising rates. This is very important, very, very important. Also, that the inflation rate is not uniform for all countries, but the interest rate given out by the ECB will. So they will try to understand to what extent you can fight inflation without squashing, let's put it this way, an incipient recovery in countries where, for example, not all companies have pricing power. This is very, very, very important. They wanted inflation to pull out of deflation. This is very simple. The question now is, to what extent is it becoming dangerous? And I think in most countries it is not. And I think the ECB is going to continue to be very cautious.
I mean, Ergas, we were speaking some months ago about the preoccupations of some economists and some analysts in the sense that inflation wasn't picking up, with the unemployment actually correcting and getting lower and lower, sort of like the model of the Phillips curve wasn't working anymore. And that was the big question mark among economists and also financial journalists and analysts. Do you think that's the case? Do you think the model of the Phillips curve is not working for some reason, one of them being a different labor market than the past?
I think the labor market has changed completely. This is not the labor market of our parents of 1950 or 1960, 1970. We have a segmented labor market. We may be seeing wage increases in specific areas, but these tend to be fairly selective, and they are for those on full-time jobs with seniority. There's a growing part of the labor force which is outside of the structured labor market, which is on part-time or very short-term contracts, which is not participating in this wage push. And this labor force is also expendable and therefore does not put through negotiating power. So I think it's a very different kettle of fish from the 1960s, 1970s, 1980s, where increase in people working was equivalent to increase in negotiation power. This is not the case today.
So what you're saying is that the sort of so-called gig economy is playing a major role in that, in the sense that inflation isn't picking up the way we would expect with such unemployment levels. So one last question is about your long-term views on inflation, because inflation is actually picking up in countries such as UK and US, a bit less in the EU. What's your long-term view on inflation? Will it eventually increase or not?
This is a very good point. I think that inflation will not go back to the levels that my generation saw it. I lived through the 60s, 70s, and 80s. I saw the very high inflation of those years. I believe another reason it will not go back to those levels is that we have shifted to a service economy where productivity gains are very hard to achieve. And therefore, if people are paid an increase which is equal to their increase in productivity, the wages will stay relatively low. So the wage push, let us put it this way, cost push on inflation will have to come from a limited number of people in high-paying jobs. Therefore, I do not see this on that front. I also believe that we will have increasingly precise and effective technology which will reduce production costs. So I think these are the two factors that are really militating against a return of the high inflation levels of, let's say, the 70s and even the 80s.
And lastly, let's also take a look at the spreads. As you can see right now, Italy, actually, it's a positive number for today. The spread today went down to 305. It's still pretty much of a high level if compared to the past, in a medium-term view at least. So it's a very, difficult topic right now. There's people sort of divided in two big groups, and one group saying if the spread goes up to 400 points between the 10-year in Italy and the 10-year in Germany, it's going to represent a big problem for this country. Some other people are saying no, because Europe cannot have in front of itself right now another bailout, another Greece situation. What is your view on that? Are you honestly preoccupied about Italy, or do you think in one way or another it's a G7 country in the end, so it will be saved, it will save itself?
This is a very good question, and I wish I had the answer. As you know, I was raised in Italy and I'm very emotionally attached. I think this is very simple. Quite frankly, this government has very few choices. This government must try something because nothing else has worked. They're saying, let's try some DIY, do-it-yourself Keynesianism. This is this famous budget, which, by the way, is still within the 3% parameter fixed by the powers that be. Now, the question of the spread is different. The question of the spread is, are we seeing markets already discounting a debt crisis in Italy? Remember, a debt crisis does not mean you don't pay, but it becomes increasingly expensive to cover the cost or to guarantee the repayment of the debt that you have bought, and becomes more difficult for the governments to issue debt at an acceptable rate. What do I think? I think we're going to be seeing more of these squalls, so to speak, in the fixed income market. The situation is far from stable. Do I believe that there will be an extraneous aid solution for Italy? Yes, I think there will be. I do not see defaults, but I do see a storm up ahead, because I think the next one is going to be when growth forecasts fall short of target, and we'll see it is extremely difficult to even stick to what they have proposed.
I mean, what's going to happen, though, if the debt is going to widen, if we take into account some measures such as the citizens' income, not only the tax cuts that the government is forecasting? What happens if the debt becomes bigger and bigger?
Well, that is the point. The question is this. Is the debt, I think, will become bigger. I do not believe that Italy is now at the point where the debt stays stable. Okay, this is not the case. I think it will become bigger. I do believe, though, that in extremis there will be some sort of backup. I do not know if this will involve, let us put it this way, fully accepting the new canons of monetary management and business management practiced by the government. But I do believe that its country is not going to default in the classic sense of the word, but that this problem will bring down the common currency. That is for sure. I think it's going to be, let us put it this way, a long war of attrition with some very sharp occasional shelling. This is what's going to happen. The problem is not going away. The problem of the Italian debt is by now consolidated in the European economic consciousness.
Right, a very quick last question. Is it a good moment to buy Italian stocks right now because they're undervalued, because they've lost a bit of momentum? I mean, Ray Dalio and people of the sort are not of the same idea, that they've been shorting Italian stocks and Italian banks mainly, not only. It's obviously it's publicly known by now. Would you short as well?
I don't know. I really don't know. I'll just tell you, my view is not Italy. My view is Europe, which is different, which I think is more encompassing. My view is Europe. I do not believe that there is any trend towards a convergence between European, let us put it this way, valuations and the U.S. I believe that they will stay, quote unquote, according to the spread theorists, undervalued. I believe that certain countries are the weak link in the chain, and I think it's quite risky. I think, yes, you can try to catch a bounce, but remember, the basic problems remain in place.
Thanks a lot for being with us today, Jean Ergas, Senior Economist at Global Capital Group.
Thank you.